As I said, when we're talking about finance, we always have a conventional financial market, right? There is a history to the financial market, and it's a place where corporates or borrowers can go and borrow money at different interest rates, different rate of returns, depending on, what are the risk of the projects, what is the duration of the project, what is the liquidity of the, investors are demanding. Now, there is a challenge to the conventional financial markets. Why we say that can't we raise finance for constructing a green building? Why can't I raise a directly, funds through equity finance or debt finance, or maybe just taking a loan for constructing a green building? Because in the conventional financial market, there is a concept of short-term financial goals. Investors are looking for earning returns on a very short-term basis. See, you must have observed in the financial markets that every quarter, the financial results of the corporates, are presented, which are unaudited. And this makes the up and down movements in the stock market, right? So why, every quarter the firms are coming out with the financial statement? Because they want to keep telling the investors that this is how we are growing, this is how your firm is growing, which leads to a concept of short-termism, which actually is a bottom line problem, which is leading to the whole issue of climate change. Because everyone is looking to generate profits by, creating a negative impact even on the environment. The second thing is that the conventional financial market still does not, understand fully the importance of sustainable investments. So there is a lack of adaptation and harmonization of guidelines. You will see that all countries have different guidelines for defining what is sustainable. In this chapter also, we'll see they have different taxonomies around the world. So there is no, harmonization or uniformity in the guidelines, which confuses the investors. Similarly, the conventional financial markets are still not accepting the fact that, sustainability is going to become an issue. But on the same point, we are also seeing that the asset under management in sustainable finance is growing year on year. What is ESG risk? People are still, trying to identify. It's very new for them to calculate what will said to be an ESG risk. Similarly, sustainable investments still have a lot of misconception going around. Some investors says that, they're going to create a positive impact, have an environmental benefit from the opportunities that they have from the sustainable investment. On the contrary, there are also investors which says that no, it does not matter whether I invest in a sustainable investment or in a non-sustainable investment. I'll still earn the same type of return. So there are challenges in the conventional financial market, which is making us move towards, a new concept of sustainable funds. This figure is taken from, the European policy, which says that if you want to, modernize your economy, if you want to go towards a circular economy, you have to focus on sustainable finance. Because redesigning the financial system, redirecting the investments into clean economy is very important. Along with innovation, along with, digital market, along with energy and climate action, we have to focus on the sustainable finance. Now, if you have seen that sustainable finance, also emerges from the, that we have to achieve the sustainable development goals as identified with the Paris Agreement. And for financing those goals, we need at the global level finance of $5 trillion to $7 trillion per year. But where is this fund going to come from? Whether it is going to come from traditional financial sources or from the sustainable financial sources. So there is a gap, and that gap will be filled by the sustainable finance. Traditionally, we look at profit, that is the financial value of our investments, but we are moving from financial value to the integrated value. Integrated value basically means the financial aspect of my investment, the social aspect of my investment, and the environmental aspect of my investment. So going from a single factor, which is profit, to a triple factors, which is people, planet, and profit, which all encompasses the concept of sustainability. Now, the chapter 5, it starts with telling you that why sustainable finance is becoming important. So it tells us that there are 5 different ways. If you look at the 5.2 concept, it says that there are, basically 5 different ways in which you can say that sustainable and climate finance are really gearing up in the market. So first way is to look at the growth in major market. Like you can see that the Global Sustainable Investing Alliance, which uses a very broad definition of sustainable finance, it says that globally assets under management are 30.7 trillion in 2018, which is an increase of 35% from 2016. And the countries like United States, European Union, Canada, Australia, they have seen a substantial growth in the sustainable and climate finance investing over the past few years. And it is tripling every year on an average. So which country has seen the maximum growth is the Japan. The second way of looking at the trends and flows is the type of sustainable investing. Like Sheetal in the beginning said that how mutual funds, ESG mutual funds are increasing, right? Similarly, when we talk about sustainable investing, you see that, and you can go to, there is this principle for responsible investment, PRI. You must be studying PRI in one of the chapters. If you go to the website, they will explain you what are the different sustainable investing methods, right? So whenever we do an investment, there are uh, different kinds of analysis that we do. Now, when we talk about sustainable investing, 3 things which are, famously being done is, one is the negative or exclusionary screening. In a negative or an exclusionary screening, we exclude all those stocks of the companies which are dealing in those products which are not good for the society or for the environment. So you are not taking into account those companies which are producing weapons, those which are maybe producing tobaccos, right? And we are only including those goods and those companies which are having a positive impact. The second is the ESG integration, and the third is the shareholder engagement. We'll focus on ESG integration and shareholder engagement in the second part of the chapter. The third way of looking at the flows is the comprehensive data source. That how your public sector, private sector, financial firm, non-financial firms, regardless of the source, how the climate finance is increasing in the overall financial market. That will let us know that how the trends in sustainable and climate finance is growing. The fourth is, and this is very important, growth of investor groupings and coalitions. And the very important coalition is the Net Zero Asset Owner Coalition, which we can see that has grown from 12 members to 37 members. So one thing is looking at the number of members which have grown, and the second is the amount of investment that they are doing as a coalition, which goes from 2.4 trillion to 5.7 trillion. And these numbers are, from the founding years in 2019 to 2021. Just in 2 years, we can see that from 12 members who were founding members, we now have 37 members. And the fifth and the most important method is looking at different financial instruments which are coming up over the years in the market, and the different financial products which the financial institutions are launching every year for the retail investors and the institutional investors. So these are the 5 ways in which you can identify, and then you can look at this table number 5.1, where you can see that, I was talking about Principle of Responsible Investment, PRI, which was founded in 2006, had 63 members. And over a period of 14 years, they have 3,038 members. We can see that institutional investors, which are becoming part of the Principle for Responsible Investment, they are signing to become a member of PRI. They are following the different the responsibly investing criteria that they have. Initially only 63 members were a part. Now 3038 investors are becoming a part of this, and they're following the criteria as identified under PRI principles, so that the investment that they are making becomes more of a sustainable investment. You can look at the TCFD, Task Force on Climate Related Financial Disclosures, which tells you the different type of climate risk and how do you identify those risks. 100 members to 1,000 members. And TCFD are the methods in which you disclose your climate risk and your physical risk or your climate risk. And Climate Action 100 Plus again is a very important coalition where the members of Climate Action are taking action towards the climate change. These different groups details are also given in your chapter number 4. Do go through them and see that how the investing is increasing, which can be identified through these climate groups. So before we move on, any questions?
No, ma'am. No, ma'am. It's perfect. It's perfect.
Okay. Similarly, you can go through this understanding climate flows by source and instrument, which again, tells you that how the investment has been going up from 2012 to 2019, from 360 billion to 622 billion. The investments are increasing in the climate finance.